Hello, this is Corner Invest. Today I'll be talking about the stock market sell-off again. So over here, you can see the stock market is down around 2% today, and from the highs, the stock market is down around 8% already. And then if you have to look at the Nasdaq is down around 13% from all-time highs, and it is already in correction territory already. So is it a time for you to sort of buy the dip on the market? So if you were to look back at history, in 2018, we had two dips in the stock market. So 12% over here and then 20% over here because of Trump's tariffs. So currently, the Trump's tariffs are a lot more anticipated as compared to back then. That's why the dips aren't as violent as back then. Back then, it was very unexpected. Trump just released tariffs on all your different Chinese companies and all your other EU countries as well. And that caused the stock market to drop 12% on one occasion and then 20% on another occasion. And on this occasion, we are down already 8% from the highs. And so is it time for you to buy the dip? So if you were to look back at history, in 2018 after Trump's tariffs, in 2019, the stock market went up by around 31%. So that just shows that Trump's tariffs are short-lived, maybe. And the tariffs actually present a decent buying opportunity if you're a long-term investor looking to buy at dips. So if you're looking to buy the dip, I don't think you should add everything at one go. Instead, try and set buy entries and just add on the way down so that you have an average cost instead of trying to perfectly time the bottom, because no one can time the bottom. The only way you can maximize the entire drop in the stock market is for you to buy in tranches and then just set buy entries as we go down. So if you look over here, we have this weekly 100 week moving average over here. So this could be one of your buy entries, and then the next one could be all the way down here as well. So currently we are at a 50 weekly moving average, so that could be one of the buy entries, and then the next one could be around $520. And I do think that the downside risk will be all the way down to the 200 weekly moving average, which is where the stock market will normally sort of like consolidate and then rebound again. So if you're looking to buy the dip, you can set buy entries. That is the way for you to approach it. With that being said, I think there are a lot of companies on discount right now, especially in the Max 7 category. So if you have to look at all the Max 7 companies, right, you have Google over here. Google is down around 20% from all-time highs already. I think this company is easily worth upwards of $200. So if you're buying now, you're basically getting a 20% discount. And then you have Microsoft as well. Microsoft has been flat in the past year already, and based on the all-time high price, it is down around 20% as well. So it's in a bear market already. You have Amazon as well, trading at around, it's down around 21% from all-time highs as well. So you have all these Max 7 companies trading down from all-time highs around 20% or so. And I think a lot of them are presenting decent buying opportunities already. So let's talk about the first Max 7 company, which is Meta. So currently Meta is down basically from its all-time highest price of around $740. So it erased the entire earnings gain. It is now around 20% from all-time highs already, and it is currently trading at a 24 times of earnings. So for Meta over here, I assigned it a 15% EPS growth over the next 5 years. So if I were to look at Meta analyst report over here, Meta is projected to grow about 13% over the next 5 years. Okay, so let's put 13 to 14% instead. And if you were to buy Meta at today's price, it will give you around an 11% CAGR, meaning to say that Meta is around 10% undervalued, which I agree with as well. Next up, let's look at Amazon. So Amazon over here is down around 21% from all-time highs already. It's currently trading at a 34 times of earnings. So if you have to look at Amazon's valuation, so Amazon right now is 5.53 times of its EPS. And then if I were to project out 15% EPS growth over the next 5 years and assuming the multiple contract to about 30 times, Amazon right now is giving you around a 12% CAGR over the next 5 years. And if you were to look at Finviz, meaning the analyst estimate over the next 5 years instead of in terms of the EPS growth, they are projected to grow about 20% over the next 5 years. So if you were to put 20%, this company over here is yielding you a 16% CAGR over the next 5 years. That is more than double over the next 5 years. And so I believe Amazon is one of the companies, one of the Max 7 companies that is presenting a decent buying opportunity today. So let's take a look at my Amazon thesis over here. So Amazon in 2023, they had an operating margin of around 2.5% for everything outside of AWS. And then in 2024, they had an operating margin of 5.4% for everything outside of AWS. And I do believe that in 2025, they will continue to expand their margins. So if you are to look at all the different revenue by segment and all the different margins, right, you have You have this portion over here, which is the advertising. The advertising is around 25% operating margin. And then you have some businesses like your subscription business, your third-party selling businesses, which are all at 10%. So these margins are extremely low. There's a lot more room for growth. And if let's say the advertising margin goes up to around 35% to 40%, there's already a 76%, 76 billion of operating income over here for Amazon already, which will give the stock price of around $212. So for Amazon, the thesis is like this. So if you were to look over here, let's say if you were to bump up the advertising to around 35, that will give you an Amazon stock price of around $245, making it extremely undervalued today. I do think that is a bit too bullish for the company. So if we were to stick to the current metrics today, Amazon is around 10% undervalued. So Amazon has one of the greatest cloud businesses in the entire world in terms of its AWS, and this is one of the annual reports by your Netflix over here. So Netflix is a competitor to Amazon Prime, and yet they are so reliant on AWS, which shows how entrenched AWS is in terms of all the different businesses out there. And in terms of your cloud businesses, you have AWS, you have GCP, and then you have Microsoft Azure as well. Amazon is the company with the best cloud service provider with the most software and most services inside the cloud. The next Mac 7 company that I'll be talking about is Google. So I think Google is at least 15 to 20% undervalued from its intrinsic value. So if you were to look at Google over here, it is down around 20% from all-time highs already. And this company over here is trading at an extremely cheap valuation. I believe it's trading at 20 times of earnings. That is just unheard of for any single Mac 7 company. Yes, correct. So it's trading at around 20.7 times of earnings. So if you were to look at FinViz over here, it is projecting out a 13% EPS growth over the next 5 years. So if you were to key that into the EPS calculator over here, 13% EPS growth, and then Google's EPS now is around 8.05. If you are to put a 20 PE for Google, meaning to say they don't expand their multiple, at current price today, it gives you around a 12.4% CAGR. And I do believe that Google, a company like Google, should command a greater multiple as compared to all your different market, because your market is already at 20 times of earnings. Why is Google at 20 times of earnings? So for Google, if you are to put a 22 times earnings on this company, it is a 15% CAGR or so, meaning to say you'll double your money over the next 5 years if they just grow 13%, which they have grown, and they have grown more than 13% over the past 5 years. So if you have to look at their earnings, you have to look at their financials over here. You have 37%, 38%, 27%. This drawdown over here was the crash for all your different tech companies, and then you have 91% over here. So Google is an extremely fast growing company. It is a company that has a monopoly in search, and so I think this company today is at least 15% undervalued. My fair value is around $210 for Google, and so it is a decent buying opportunity if you're looking at a Mac 7 company to own today. Next company over here that I think is quite undervalued is Booking Holdings. So Booking over here is trading at a 25 times earnings, 21 times forward earnings, and this company over here is growing massively. So if you were to look at the growth over the past few years, you have revenue growth of around 11% revenue growth, plus 6% of buybacks. That is 18% already if they don't improve their margins. And Booking is constantly trying to improve their margins over time. So the management is projecting around 8% revenue growth, meaning they want to hit the goal of around 8% revenue growth in the long term. And if you were to add just 6% of EPS, 6% of share buybacks on top of the 8%, that is 14% already for the company organically without margin expansion. So this company over here growing at 14%, trading at around a 25 times earnings, I think it is undervalued. It is trading for lesser than a 2-pack. And if you were to just look at this company over the past few years, it has constantly been on a secular growth trend, because travel is never going to stop. Travel is a secular growth business. But for this company over here, I don't think it is extremely high quality as compared to Amazon, Microsoft, Google, and Meta. It is a company that is facing competition from other competitors like your Airbnb or Expedia. But this company over here, what differentiates it is it holds the greatest market share in the EU market, because your EU market is extremely fragmented. So all your different small hotels, they cannot really afford to pay high advertising costs. And so what Booking has done is they have sort of like liaised with all these different small hotels, and they've allowed them to place their listings on Booking so that they can get more exposure, get more customers and all that. And that is what Booking did at the very beginning, which led to its great market share in the EU market. All in all, I think this market is a bit oversold right now, so we will likely get a relief bounce soon. Not sure when, but tariff sell-offs are decent buying opportunities in general if you're to look back at history. So buy your own risk, buy every dip if you want, but I'm adding.